I'm Clayton Collins, CEO at HousingWire and your host for the Housing News Podcast. Today's episode is part of a special series of podcasts which we recorded in person at HousingWire Annual in Austin, Texas. Our guest today is Adam Carmel, CEO at Polly. And in this conversation, we talk about mortgage pricing and capital markets, all the important topics that are influencing mortgage rates today. Adam brings an exceptional amount of knowledge from his experience as a technology entrepreneur and operator, as well as an independent mortgage bank executive. This episode is especially timely because next week, HousingWire's Tech 100 award nominations open up. Polly was a 2023 Tech 100 winner, and we can't wait to see some of the nominations that we get for our 2024 Tech 100 cycle. I hope you enjoy this episode of Housing News with Adam Carmel, CEO at Polly. All right, good morning, Adam. Thank you for joining us.
Hi, thanks for having me.
So folks, we're here at HousingWire Annual, and I have the pleasure of sitting down with Adam Carmel, founder and CEO of Polly. And we're going to talk about some of the learnings that came off stage yesterday, some of the issues that are front and center on the HousingWire.com website and through our newsroom, and some of the perspectives that Adam is picking up in market as he talks to clients and lending executives across the industry. So Adam, I want to start out on analytics. Yesterday, we had the HousingWire Annual Vanguard Forum, and one of the sessions was highly focused on how well executives understand their business. And at Polly, you're working on bringing forward data and intelligence and market information to the front and center, not just market information, but also internal analytics for clients. Can you tell us about how you're enabling a more transparent management style for lenders at this pretty important time in transparency?
Sure, absolutely. So, historically, there's been the consumption of data and analytics has been pretty analog, maybe one-dimensional. You could look at a certain report and say, okay, this is my lock volume from yesterday, and then try to make decisions off of that one report and then combine it with other reports. What we've instead thought about is, well, how do we create a platform here that is multidimensional and relational and is able to, through machine learning, also help to predict and to inform what decisions should be made in the future, whether it's through workflow, margins, et cetera. Yeah. So we really try to take things to the next level and be more predictive.
Can I pull in that thread of relational? What does relational mean in this context?
Yeah, so for example, if a lender says, okay, well, my capacity to take in locks is 20 million per day, I want to execute it on a blended basis, 100 basis point margin across all my channels, geos, whatever, all the various parameters. They're able to take all of those different relationships into account and then make decisions or just have it all automated within the system.
So I'm going to move on and talk about pricing in the market, Adam. So rates are high. We're in a tough environment where, as we have this conversation, we're looking at rates that are in the 7.5 range, from 30-year fixed rate average mortgage rates, and a big part of that is spreads over the 10-year, which are at least like cycle highs. I don't want to say all-time highs, but we're at spreads that are 300 basis points over the 10-year. And this week, Doug Duncan, chief economist at Fannie Mae, had some commentary that he doesn't see spreads coming down anytime soon. So can you give us kind of a two-stage insight here on what's causing this widespread, and then how do you see this issue resolving or not resolving itself?
Sure. So first of all, it's probably just pretty basic in this capacity. There's just not a lot of demand for the asset class in the market, right? In the capital markets. And so, why, for example, own MBS at whatever the prevailing coupon is when you can go buy corporate bonds or high yield debt in the low teens?
Absolutely.
So that's number one. So there's like this relative performance that they're contending with, the MBS market's contending with, and then second of all, it's probably the case that we're closer to the peak in rates than we are to the trough. So there's just embedded duration risk, at least perceived, than maybe a couple years ago, certainly, and as rates start to decline, probably spreads tighten up a little bit, just because then you're maybe closer to the trough than you are the peak.
So if we have to put this in context for loan originators and production leaders who each and every day
whether they like it or not, are asked which direction rates are going. I'm not going to ask you to shake the crystal ball, but how do you take this expertise that you're talking about, some of the commentary that Doug Duncan brought to the market, and tie that back to advice that originators need to communicate to home buyers?
Yeah, in terms of forecasting, I don't. I'll quote, I think, Larry Summers, who's quoted many other people who've said there are two types of economists. The first economist is the people who say they don't know. And the second economists are the people who say, I know that I don't know. So there's really no point in trying to forecast. Now, in terms of what loan officers should be conveying to their customer is, well, we don't know where rates are going to go. If you're looking to buy this home and you can afford it and you qualify, well, then now's the time to do it. I mean, it's well understood that what's the old adage in the industry? You marry your house, you date your rate.
Oh, God, it's such a terrible yet kind of true.
Well, I mean, the consumer has basically a free call option forever to refinance their home. So at worst, they lock in the rate, rates go up, great, they're in the money on that home. At best, they just keep on refinancing out of their home until then they end up getting effectively a free tax break.
I was having a conversation with Renee Rodriguez, who's speaking twice today. He's moderating a conversation with Sean Panosi, and then he's also doing our lunch keynote. And Renee is a master at communicating well. And one of the points he was making is, hey, if you're a loan originator, there's a couple things that can play out here. You buy a house today at a rate you're uncomfortable with, and rates go up further, and you come back to your loan originator and say, thank you, you got me in at 7.5, and now we're north of 8. This is huge. Or they go down, and you call your originator and say, thank you for the refi and helping me get a lower rate. So
you're always happy.
Despite the massive payment that you're going to be responsible for as home prices and interest rates.
I mean, but if you look out over a 40-year period, rates are kind of back to, they've reverted to mean over a 40-year period. So it's just that the consumer has been conditioned over the last 10, 15 years on these super old, ultra low rates, and we're not going back to that period.
All right, so Adam, at Polly, you are out having sales conversations with prospective Polly customers, and also interacting with existing clients. What are you hearing from your clients? What's the message you're hearing right now?
It's probably mixed. There's a certain cohort of customers and partners who have said, hey, we're really committed, we're really focused on our kind of 3-year or 5-year strategic plan, and we want you to be a part of it. And we want to upgrade technology and drive automation and drive margin granularity and efficiency and so forth. Then there's another cohort of customers that it's a tough time. And so they're talking about, fewer loan officers or making other cuts. And then looking at really mission critical parts of the business. We fortunately operate in a part of the software stack that is mission critical. And so it's just then about, well, how can we help them get implemented if they have fewer resources available to them?
So in your career, you have operated a mortgage lender and now operate a technology company. You're going to have to go back and put your mortgage lender hat on for a minute. You talked about how we're probably closer to peak rate than trough rate. I happen to be of the belief, and I will knock on wood here, that we're closer to peak pain than we are, and there's some positivity to come in this market as we look forward. If you're an IMB leader, how would you be preparing your business today for what comes next? Whether you believe that's more pain or you believe that's opportunity.
From what I've seen in my years in this industry, like you said, on both the mortgage banking side and now the software side, and this is, by the way, I think applicable for just generally the macro picture. Usually when everyone's running left, I kind of like going right.
You sold a mortgage bank and used the proceeds to start a software company. That's one of the more unique, if not contrarian, moves I've ever seen.
So I've historically just been contrarian, and I think in this industry, you've got to make hay while the sun is shining. So when the rates are favorable, you really need to fortify the balance sheet, retain servicing, et cetera, when we're in this type of period where rates are much higher, and this is historically tough, it's a time to, look at your people, your process, your technology, and policies and so forth, and build a business for the future. Now, I think if I was running a mortgage company today, I would continue to do that. I'd be very cautious. The winter might be quite challenging.
Are we talking like Game of Thrones winter, or you're literally talking about like December, January, February?
Yeah. I'm saying the actual winter of December, January, February.
All right, got it.
I think next year could end up surprising to the upside, and people should probably prepare for that and think through more planning. Okay, how do I get through the next 3, 4, 5, 6 months, whatever? But then how do I help to position myself 12, 18 months from now? All right. All at the same time. Very, very hard to do.
Adam, thank you for joining us at HousingWire Annual. Thank you for joining us for this recording. Always enjoyed talking to you, and you brought some really unique expertise. So
Thanks for having me. Appreciate it.